Most people freeze up and panic when they hear the term investing, thinking that you've got to be some Ivy League graduate working on Wall Street to capitalize and make money for investing. This is what those people want you to believe, to justify their ridiculous fees just so that you don't get ahead in life. But luckily for us, this is BS, and you can also make an insane amount of money for investing if you understand the basics and approach it correctly. And no, you don't need to do anything illegal to become the wolf of your street. Today, I'll remove some of the myths and help you to understand how you can easily get started. Investing is like planting a seed. With the right nurturing and enough time, it can become a big ass money tree. Let me show you exactly what I mean. Let's say you invest $1,000 into the SPY ETF, then you dollar cost average another $500 a month for 30 years. Applying a long-term growth rate of 10.13%, you would enjoy a delicious bounty of 1.2 million with a net gain through compounding interest of 1 million over that time. How friggin' sweet, eh? Beats any regular tree that I've planted before. Right, now before you start running out into your back garden and start digging a big ass hole, a hole in the ground, you dirty-minded people, let's clear up some basic concepts. Also, I'm not a financial advisor, so everything in this video is intended for educational purposes only, based on my knowledge, research, and experience. In other words, do what you like.
Please, don't sue us.
Firstly, let's define the term investing. At its most basic level, investing is simply putting your money to work for you, instead of letting it sit in a bank account like a sad, lonely potato, depreciating in value. You know, the one left in the back of your cupboard that starts to sprout and eventually goes all moldy. Yes, none of us want that. To avoid this and start growing that big ass money tree, you can invest your money in things like stocks, bonds, real estate, crypto, classic cars, paintings, and even race horses. With investing, the goal is to make your money grow over time, hopefully beating inflation and that nagging feeling that you should have bought Bitcoin 10 years ago. I'm actually still annoyed I didn't, and even more annoyed that I sold my holdings at 10,000 just before it hit an all-time high of $69,000 in 2021. 69? Funny number. Wonder why I only hit that. On the point of inflation, this is a truly dangerous thing, and most people don't even fully understand how bad it is. Let's put it this way. If your money is just sat in a low interest bank account, each year your money is becoming worth less as your buying power decreases. To put this into perspective, in 1970, in the United States, a cup of coffee cost 25 cents. But in 2019, that same cup of coffee cost $1.59. And today it costs $3. This is inflation, and it's stealing all of your money. Over the last few years with record inflation, this is catastrophic. Therefore, you owe it to yourself to ensure that you are mitigating this by investing to at least meet or exceed inflation. Now we understand the dangers of inflation stealing your wealth, what investing is, and why it's important. Let's jump into the types of investments. As we've touched on, there are different types of investments, all equally as confusing as one another, and all with their own risks and rewards. Let me talk you through the most basic and common ones. Up first, we have ETFs, aka the investment basket. Imagine a picnic basket overflowing with delicious goodies. That's an ETF, an exchange traded fund. In a nutshell, instead of holding just one apple, it bundles a bunch of different assets like stocks, bonds, or even other ETFs. This diversification spreads your risk and gives you instant exposure to a particular market sector like tech or clean energy. Think of it as buying a variety pack of chips or even a tub of pick and mix sweets. Instead of just one of your favorite flavors, you get a taste of everything. The example I gave at the start was based on an ETF, the SPY. No, not James Bond. It's an ETF based on the S&P 500, which is a stock market index track of top 500 largest companies listed on the stock exchanges in the United States. Up next, we have bonds. You can think of these as the loan shark, but friendly ones. Ever loaned a friend some money and hoped that they'd remember to pay you back? Government and corporations do the same thing with bonds. You basically lend them money for a set period in exchange for interest payments. Think of it as your own personal ATM, splitting out cash at regular intervals. Bonds are generally considered less volatile than stocks, making them a good choice for risk-averse investors seeking a steady income. Now, let's get into stocks, aka the Owners Club. Ever wanted to own a piece of your favorite company? Stocks make that dream a reality. By buying a stock, you're buying a tiny slice of a company. If that company does well, its stock price goes up and you make money. But if it stumbles, your investment shrinks. Stocks are considered high-risk, high-reward investments, perfect for those seeking potential big returns and the thrill of the ride. Stocks are made up from anything from penny stocks, think of the pink sheets in The Wolf of Wall Street, aka smaller companies considered more risky and less liquid, through to the big blue chips such as Apple, Tesla, and BP. Before you think, what the heck is liquid? What is this guy talking about? I thought we were talking about investing, not buying pints down the local bar. I'm referring to how easy it is to buy and sell your stock. The higher the number of shares traded, the more liquid a stock is. For every trade, you need a buyer and seller. The less people looking to buy and sell, the more illiquid a stock is. To prevent any issues and to get the best execution price, you want to buy a stock that's highly traded and therefore liquid. Just like your drink, the more available, the better. Or at least in my view. Now, let's get into the mysterious beast that is crypto, aka the digital roller coaster. Buckle up, because crypto is taking you to a whole new world, the virtual one. Cryptocurrencies like Bitcoin and Ethereum are digital assets not backed by any physical goods or governments. Their value is determined by supply and demand, often leading to wild price swings that can make your stomach do a loop-de-loop. Crypto is highly speculative and carries significant risk, but for those with a taste of adventure, it can offer potentially life-changing rewards. In fact, I personally know 7 friends that became millionaires from crypto. Crypto is a fascinating and potentially lucrative investment, but it's crucial to understand the significant risks involved. It's not for the faint-hearted or those seeking guaranteed returns. Before venturing into the digital roller coaster, make sure you've done your research, understand the technology, and have a strong risk tolerance. If you're ready for the thrill, buckle up and enjoy the ride. Just remember, there's no guarantees you will come out a millionaire, and a lot of people have lost a lot of money. Finally, let's talk property, aka the brick and mortar playground. Okay, let's get back to something less wild. Owning a house, apartment, or even a slice of commercial real estate can be a fantastic way to build your wealth over time. Rental income provides a steady stream of cash, while the property itself can appreciate in value, potentially making you a tidy profit when you sell. Real estate is a long-term game though, and it comes with its own set of responsibilities like maintenance and tenant woes. Now that you have a good understanding of the different types of investments, it's time to plant that seed and start building your portfolio. The first step is to define your goals and ensure that you're prepared to start investing. Before setting sail, know where you're heading. Are you aiming for long-term wealth building, steady income, taking a gamble, or a mix of all three? Before you start investing, it's advisable to ensure that you paid off all of your high-interest debt and have an emergency fund. Step 2 is to choose and open an account. Okay, now for the fun part. Choosing an investment platform. Each platform has its own perks and fees, but for the sake of simplicity and as beginners, choose a platform that offers you the low-cost ETFs. Personally, I use Trading212, Hargreaves Lansdown, IG, Revolut, and Freetrade, but there are others like Fidelity, Vanguard, eToro, Charles Schwab. A Google search in your jurisdiction will show you a variety of options. Just make sure you do some research on them before you start investing your money there. As the gym rats would say, you gotta protect those gains, bruh. Up next, as part of step 3, is to start investing. For beginners, for the reasons discussed earlier, in addition to being one of the most easiest and simplest things, it is recommended to start with ETFs. They're the perfect training wheels, spreading your risk and offering instant market exposure without picking individual apples. I actually saved up and paid for my 60k MBA by investing in ETFs. Make sure you do your research, explore options that align with your goals and risk tolerance. Consider broad market ETFs like the SPY, S&P 500, or the VTI for total US stock market for overall growth. Invest gradually, don't go all in, start small and increase as you gain confidence. Diversify, don't put all of your eggs in one basket. Spread your bets across different asset classes and sectors within ETFs. Once you feel comfortable and want to level up your game, plus expose yourself to potential high returns, yet higher risk, consider venturing into individual stocks. This lets you personalize your portfolio and potentially score high returns, but comes with increased risk. Here you need to level up your research. Dig deep into company financials, market trends, and competitor analysis. Diversify still. Remember, spreading your bets is key. Buy for the long run. Focus on companies with strong fundamentals. Avoid chasing quick gains. Finally, step 5, for those of you who really want to advance in the world of investing, start expanding your horizons. As you gain experience, consider venturing into other asset classes like property, bonds, or even crypto, but that one with caution. Each of these offers unique benefits and risks, so do your research and invest strategically. Investing is like a lifelong journey, not a sprint. Don't panic at market fluctuation, stay invested, rebalance your portfolio periodically, and keep learning to become a savvy investor. Remember, this is just a roadmap. Tailor these steps to your specific needs and risk tolerance. Most importantly, start small, educate yourself, and enjoy the exciting ride towards financial freedom Finally, investing can be a roller coaster with ups and downs and the occasional loop-de-loop. Don't panic at the first dip, stay calm, remember your long-term goals and avoid emotional decisions. Time in the market always beats trying to time the market, and over the long term, the stock market has always gone up. When you see a crash, don't panic. Unless it's the market crashing because of a zombie apocalypse, then maybe panic a little and go and grab your gun. There are plenty of resources available to help you to get started with investing. Online brokers, financial advisors, and even YouTube channels like this one can provide guidance and support. Therefore, please follow and subscribe if you're enjoying this content. Finally, to recap, here's your investment type cheat sheet. ETFs, the diversified picnic basket, good for beginners and steady income seekers. Bonds, your friendly loan shark, ideal for stability and regular interest payments. Stocks, the ownership adventure, high risk, high reward for the thrill seekers. Crypto, the digital roller coaster for the brave souls who enjoy extreme volatility and potential life-changing gains. And finally, property, the brick and mortar playground, offering long-term wealth building and passive income, but with higher upfront costs and responsibilities. Now go forth and explore. Remember, investing is a journey, not a destination. Do your research, diversify your portfolio and stay informed. And most importantly, have fun navigating the exciting world of making your money work for you. Now, go start digging that big ass hole.